but some of it does appear to be transient or idiosyncratic.
There is a possibility on the other side of this that inflation could actually be quite low. Inflation has persisted longer than we thought.
You know, I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. It is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed.
So far, the only thing that Jerome Powell and the Federal Reserve have managed to do is to create more inflation and lie to all of us about it. Now, as you guys know, yesterday on Wednesday, the federal funds rate was cut down to about 4.22%. You guys can see that little tiny cut right here. Now, a lot of realtors, a lot of loan officers were all saying it's time to refinance. They're going to cut rates again. But as you guys see in this chart here, the 10-year Treasury, which tracks residential mortgage rates, actually exploded upward with the rate cut, which is exactly what Mitch and I have been telling you is going to happen, because that's been happening this whole time. People get this incredibly wrong. That sent residential mortgage rates once again over 5%. You guys remember the video we did, and we asked the question, will interest rates stay under 6%? Because that's really what America wants to know. And as you guys can see right now, conventional has shot back up to 6.33%. FHA is now 6.05%, above the 5.99 that so many people were hoping for. The market is anticipating another rate cut December 10th of a quarter basis point. About 72.8% of the market expects that. Regardless of what the Federal Reserve does next, the refinance index, so this is the applications for people that want to refinance, look at how this thing skyrockets upward. I mean, refinance applications have exploded. These are not closed transactions. These are only refinance applications. It shoots up, guys. I mean, think about how desperate someone has to be to save a couple bucks, yet pay tens of thousands of dollars in fees and interest just to refinance. Now, when we scroll down to the purchase index, you guys can see that it's floundering once again, and that anytime the Federal Reserve injects themselves into our markets, things go absolutely sideways. Now, let's do the comparison, and I'm going to show you guys a difference between a 6% interest rate and a 5% interest rate, so you guys really understand it's not the rates that matter, it's the price, because even if your rate goes down to 5% or 4.99%, you're only going to save about $160. Meanwhile, your property taxes and your homeowner's insurance is eventually going to go up more than the reduction of interest rate. That is why fundamentals and price are so important. But nevertheless, take a look here, $350,000, 20% down payment, 30-year term, 6% interest rate gives us a payment of $1,678. When I go to the 5%, same criteria here, it goes down to $1,503. But I want you guys to remember, it also takes you guys about 4% in closing cost just to refinance. Plus, if you do that, if you refinance, you're also going to pay all of the interest all over again in the amortization schedule. So you can see if you've been holding your mortgage for 3 years at a 6% interest rate and you refinance into a 5% interest rate, you have to start the 3 years all over again, which means you're going to basically pay over $42,000 in interest plus the 4% in closing costs, which equals around almost $60,000 if you guys refinance from a 6% to a 5% and you've held that mortgage for 3 years. So I really want you guys to be careful on who you're listening to when it comes to refinancing. Refinancing generally helps the banks and gives homeowners a very short-term payment relief until, again, property taxes and homeowners insurance skyrockets up. Mitch, the really important question that every single person is trying to figure out right now, and maybe you can articulate this, what the heck is happening? In other words, okay, I'm sorry, I'll clear that up. Why is the federal funds rate being cut? And then immediately, Mitch, the same day, every single time, the 10-year shoots up and consumers pay the price again.
Fraud by virtue of inflation. And I want to point something out. In 2021, 3 incredibly famous words were spoken for. Inflation will be transitory, as stated by Janet Yellen and repeated, that's U.S. Treasury, by Jerome Powell, Federal Reserve. Those 4 words, inflation will be transitory, are more than enough to justify the closure of the Federal Reserve. Because do you realize from 2021 to today, the US deficit, money not there to pay for anything, which means more money has to be printed, is in excess of 10 trillion in that time frame. Almost 5 years. 10 trillion. The answer to the question, straight up fraud.
I got to be careful asking this because I have my own opinions here, right? But will we ever see 4% residential mortgage rates again? Like mom and pop can go get a mortgage, they can get 4%. We ever going to see that again? Or are prices just too high to usher in low interest rates again?
It's possible, but not probable. So what you're seeing play out, and the reason why I've been saying interest rates are going to go up, not down, regardless of what the Federal Reserve does, because when the Federal Reserve lowers interest rates, think of it this way, and Powell did say it this morning, that they are concerned about unemployment rising. Well, if unemployment is rising, then so is risk in the market. If risk in the market is rising, then so must the interest rates. Dropping the interest rates a quarter basis points, look at what the market did. It went up. Direct correlation. Powell drops, interest rates to mom and pop go up. So the point being that when there's stress, interest rates must go up because there is risk in the market. Well, I understand, and it does make perfect sense why President Trump absolutely wants these interest rates to drop. That's because the cost of financing the deficit that I just mentioned would go down dramatically. But that's at a government lending rate,
Yeah.
peer to peer, government to government, bank to bank. It's got nothing to do with mom and pop. And what you're seeing now is that, in fact, the interest rates, if I'm not mistaken, went up on the 30-year to 6.25% to buy a house today.
Mitch, do you think that we should have lower interest rates as far as residential mortgage rates? Should those go down to 4%? Would that help or would that hurt mom and pop overall?
It won't make any difference. And the reason why it won't make any difference, on its face, you'd say, hey, yeah, that would be great because then the interest rates go down. Look at all the money we can save on a mortgage. But that money, as I've been saying, is being equity stripped right out of your pocket while you sleep. And you can't do a thing about it unless you stand up at your school districts. Why? Because the school districts are increasing your property taxes, which means that your equity coming straight out of your amortization schedule is being taken from you. Anything you save in terms of a mortgage, you go to do a buy down, that money will be flipped in a matter of 60 days from the date you close. They're going to say, well, your property value went up. There's nothing in law that it makes that statement true. They are breaking the law. We have the proof. That's everything that's on my website. We literally have the proof. We have the proof that the courts don't want to deal with this issue. And the only way to fix this is mom and pop getting involved. You're going to have to get involved. And to that point, if I may, we've got Greg Cooper coming up on a video tomorrow, and that's going to be an astonishing video. We've been hammering on Godly Texas now for almost 60 days, and I think we're making good progress. Greg Cooper is ex-military. He left. He moved out of Godly because he saw this problem. He understands exactly what's going on, so that should be a really good video.
Well, unfortunately, Mitch, that's not really good service from our government because one thing that they're not going to do is they're not going to unify mom and pop to fix this problem. More than likely what they're going to do, as you know, is quantitative easing. And so I'm going to go to the next segment now. And at the end of the segment, I'm going to ask you whether or not you think that they're going to do $10 trillion in quantitative easing, because that's the only amount of quantitative easing, the strength of quantitative easing that's needed to squeeze the juice out of the stone. But let's take a look at this article from Zero Hedge. The Fed's pivot, the return of easy money, and inflation storm ahead. Not a very good title, very scary. Jerome Powell, the Fed's chairman, recently gave the clearest signal yet that the Federal Reserve's so-called quantitative tightening is about to end. If you've been paying attention, this shouldn't come as a surprise. The playbook has been obvious for a while. First come the rate cuts, which are happening right now. Then they stop quantitative tightening. Powell just confirmed this. And then comes quantitative easing, or good old-fashioned money printing. This article is saying probably sometime in early 2026. Some of the reasons are the job market is collapsing. Companies have announced almost 1 million job cuts so far this year. That's a 55% jump year over year and the highest since lockdowns in 2020. Meanwhile, Americans are searching help with mortgage on Google's at levels not seen since the 2008 financial crisis. People can't afford to stay in their homes. With mortgage rates around 6.3% and inflation compounding 10 to 15% over 4 years, it's way more than that. Homeowners are tapped out. The Fed can't fix these problems with rate cuts alone. So they're going to do the next phase of this process, which is ending quantitative tightening now and firing up quantitative easing soon. The tightening that hardly was. I love this article. But here's the irony. The Fed is ending QT or quantitative tightening before they've made any significant dent in the mountain of cash they created last time around. If you look at the chart below, you'll see that since June of 2022, the Fed has reduced its balance sheet by 2.2 trillion. Now that sounds impressive until you realize they're still sitting on $6.6 trillion. And I'll argue they stole that from mom and pop. In other words, the Fed is nowhere close to the pre-pandemic levels of roughly $4 trillion. After more than 3 years of tightening, they've only managed to shrink their balance sheet by about 27%. To say that's unimpressive would be a gross understatement, but it's all by design. The simplest way to reverse QE would have been for banks to return the money to the Fed in exchange for their bond. But that was never going to happen. The Fed and the big banks seem quite content letting all the cash slosh around Wall Street, Nvidia, etc., pushing markets to record highs while the rest of us deal with the inflation. Also data centers. Another option for the Fed is to sell bonds directly into the market, but they know that dumping a significant portion of their $6.6 trillion bond portfolio could crash the bond market. Who's propping up the bond market then? The government and the Fed is propping it up. So if the Fed stops propping it up, what happens? We naturally go into depression. Our economy will naturally deflate. You can guarantee that. And that's why I'm going to ask Mitch, is it going to take 10 trillion? Because they've already printed trillions and trillions of money already that they don't have. So instead, they opted for the slowest, most painless approach, letting bonds roll off as they mature. In other words, they didn't print new money to replace the maturing bonds, which means they didn't really sell mortgage-backed securities, and that's what we needed from them. According to Powell, this is what Powell's saying, normalizing the size of our balance sheet does not mean going back to the balance sheet that was before the pandemic. We believe the Fed's move back into easy money will set off a massive bubble in commodities, especially in monetary metals like gold and silver. That's why a big portion of our crisis investing portfolio is in mining stocks. Mitch, is the only way to keep this whole dysfunctional party going is for the Fed to print 10 trillion. In other words, and this is my point, and it's very specific, nothing else is going to work. And obviously 10 trillion is also not going to work. It will turn us into the Weimar Republic, potential civil unrest and civil war. But nevertheless, in their minds, is that what it's going to take? Is that what they're going to ask for? Say 5 to 10 trillion. Do you believe that is within the range of the next quantitative easing package, 5 to 10 trillion?
No, game over. So the Weimar Republic would be literally here, because when you print, de facto, that's a default. They may not like that word, but that is the reality. When you print money, you're defaulting because you are creating inflation. You're creating inflation to pay previous debts with money that's worth less money. That is a default. Inflation is a hidden tax. That is the default. So this is exactly what I've been trying to teach mom and pop and even the government that's watching these videos, which is to repeal all property tax in favor of the uniform state sales tax. And if you simply look at it and say, we're going to claw back the portion of the fraud that has occurred for the last 6 years, that would take a major portion of the fraud completely out of the equation that we're now facing. And that would be recasting the debt. Recasting debt is not a default. There are solutions to this. There are ways to get out of this at the mom and pop level, which is the property tax level, as well as at the federal government level. But as long as somebody is promoting this idea, well, we can just print our way out of it. No, they're delusional. They're wrong. This will end up in a greater depression. There's no reason for it other than their own ignorance and not willing to do what is necessary to be done.
Well, do you think they ever even stopped quantitative easing, or do you think they just slowed down? Bank term funding program, reverse repo market. Can we argue the fact that they never even fully stopped doing quantitative easing?
I don't believe they have. I mean, the statement, inflation will be transitory. Why would anybody say that when you're printing money? In other words, it's part of the game to keep the illusion that everything is fine going until they come up with some sort of other solution, such as, well, we're going to switch over to Bitcoin and we're going to think about this and we're going to go into this meme coin. None of that is going to work. And the reason it won't work is until they connect it to true commodities, hard assets, everything is just speculation.
Well,
So you cannot be speculating with mom and pop's lives and their ability to put food on the table. That's where the rubber hits the road.
yes, sir. But that's exactly, to the T almost, what the Federal Reserve is doing. And so I want to end this video out, Mitch, by listening to just a few moments of what Jerome Powell has to say about what they plan on doing with inflation next. I'm going to need everyone to calm down and sit for this next segment.
The outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem.
Well, Mr. Powell, then please just stop printing money. We could fix the inflation right now. Just stop printing money. Mitch, my first question is, go ahead and share your thoughts on that video, but can you first answer, when do you think, and I hate to say it because it's theft, but when do you think that they're going to start quantitative easing again? Do you think, like the article is mentioning, the beginning of 2026? When do you think that's going to happen, if at all?
Listening to Mr. Powell, he may be a very nice guy, but the only thing I can think of is brain freeze. Somewhat downward employment market. How does that affect the 300,000 people that are about to get laid off? Somewhat downward employment market. So let's get this straight. On one hand, we're raising interest rates in order to bring inflation down. That's on the left hand. On the right hand, we're printing money, which raises inflation. This is pure schizophrenia. There's no other way to describe this. These people are nuts. This is exactly why the Federal Reserve should be shut down. I could literally take a 5-year-old, sit that 5-year-old down on the floor, give that 5-year-old a quarter and say, heads or tails? Heads, we raise interest rates. Tails, we lower interest rates. The entire Federal Reserve could be replaced with a 5-year-old and a quarter. Everything that's coming out of their mouth is pure schizophrenia. There's no other way to look at this. And this plays the games. And to Travis's original question 2 questions ago, it's really dead on point. How is it that this can be happening? What are they still in quantitative easing? The answer is yes. They never left. It's an illusion when they say, well, we're going to raise interest rates in order to slow inflation down. Okay, did that work? Anybody out there? When's the last time we went and bought groceries? Well, clearly it didn't work. Therefore, schizophrenia and/or straight up fraud.
Okay, fair enough. So when do you think they're going to speed up, because they never stopped quantitative easing? When do you think they're going to speed up quantitative easing again? Like, print a big package, trillions of dollars. Do you think that's going to happen next year? Think it's going to happen at all? What do you think?
They've got mechanisms that they can use. One of those mechanisms, shockingly enough, okay, don't put out any more treasuries. Peel back the fraud, recast the debt. You've got mechanisms rather than going into default. But there's a much higher probability of straight up default if they turn those printing presses on full throttle, where you're printing, as you said, 5 trillion, 10 trillion. It's a straight up default. There's no other way to look at it. Gold will take off. Anything with hard assets will take off because people will be looking for places where to put the money that's safe. Real estate that's bought and paid for with no debt, because you're going to have hundreds of banks collapse. And it'll happen very quickly. This is what happens when you print. You create more systemic fraud. And there's no way out of this. They have pushed this button so hard for so long, at least for the last 25 years, going all the way back to 2000. But remember the rule of 72, these debts compound by virtue of the fraudulent, outstanding, compound cumulative interest. The principal was a fraud. The compound cumulative interest is a fraud. These are mirrors. What's happening at the Federal Reserve is a mirror of what's happening at the Central Appraisal District. They've got themselves in a box that only a recasting of this debt and only the repeal of all property tax in favor of the uniform state sales tax is the only way out. There is no other way out. They've got a problem. They created it, and they're going to have to deal with it the easy way or the hard way.
It's going to be the hard way. That's where my money's at. But Mitch, can you please give us our conclusion today? Maybe you could talk about and give the viewers an update on the advocacy plans.
We're working and we're penciling out the idea of a very comprehensive website, easy to understand. So it's not based on 100% slam the information down your throat. Much easier to understand, much more user-friendly, with the idea of being able to invite people in and say, here's lists that you can take to your school district and ask these questions, which will help educate you. So it's not that we're pushing as much as we're saying, here's the motivation from which to do this. And there's a book that I've written. It's done. We'll see what we decide to do with it if we publish it. That'll be part of that. All the websites that we're connected to will be part of it. And we're even going to invite people from other states to say, post your information here, and we'll start breaking this down so it becomes a funnel with the idea of casting across the United States dozens of class action lawsuits. So it's a funnel that ends up coming down to class action lawsuits. We're working on it. It's not the easiest thing on the planet to get this done, but we're trying to stay away from so much heavy information and try to make it to the point where mom and pop can quickly understand this.
To say that I'm excited about when this is finally going to be rolled out is an understatement. I am beyond excited. I feel like this is our purpose, and you don't always get to live life feeling like you know what your purpose is, but I feel like my purpose is helping mom and pop. We'll see what God has planned for me. But either way, you guys, don't forget to go to the links in the description. Go to our websites. Our entire websites are designed to empower mom and pop to not make any money off of you, but to call you to stand up with us and unify. And let's take back our country and give it back to its people, which is you and which is me. Now, other than that, guys, if you guys are out there just trying to figure out what's happening, living your life, whatever it is, you already know that I'm going to tell you, never lose hope. Love yourself. We always appreciate you, and we hope you win.